Have you ever felt like no matter how carefully you plan your finances, the global economy always finds a way to surprise you? You're not alone. Almost every investor, new or experienced, has at some point been caught off guard by something they didn't see coming. Now imagine this. One of the world's most powerful financial institutions, BlackRock, is showing signs of instability. And no, this isn't just another headline. This could directly affect your investments in ways you haven't even thought about yet. Even if you believe you already understand what's happening with interest rates, credit defaults, or the economy in general. This video will show you something you probably missed, because the real danger isn't what's visible, it's what's quietly building underneath. Let's break it down. In this video, we're going beyond the headlines and social media panic. You'll discover what exactly is happening with BlackRock right now and why it's not just a one-off incident. How a sudden spike in corporate defaults is triggering ripple effects across the credit market. What this means for average investors like you heading into 2026. And most importantly, how to protect your money before it's too late. But here's the twist. Even if you've already read articles or watched news about BlackRock's exposure, there's one critical layer almost no one's talking about. And that's where your financial safety truly lies. We'll get there. But first, let's understand how we reached this tipping point. Over the past few years, the global financial system has been walking a tightrope. Governments pumped trillions into the economy during the pandemic. Interest rates were near zero. Money was cheap and big corporations borrowed aggressively. BlackRock, managing over $9 trillion in assets, played a central role in navigating that landscape. From bonds to real estate, from government-backed securities to corporate debt, they were everywhere. But here's the problem. As interest rates began rising rapidly in late 2022 and through 2023, the cost of borrowing skyrocketed. Companies that once had easy access to cheap credit suddenly faced pressure. And now, in late 2025, we're seeing the aftershocks, corporate defaults are accelerating, and even giants like BlackRock are showing cracks. So what does a credit collapse actually mean, and why is BlackRock at the center of it? Think of credit as oxygen for corporations. Without it, businesses can't grow, refinance debt, or even survive. When interest rates rise, borrowing gets expensive, and when defaults begin, panic spreads fast. BlackRock holds massive exposure to corporate bonds, mortgage-backed securities, and high-risk credit assets. And now, with defaults skyrocketing, the value of those holdings is plummeting. Investors are pulling out. Confidence is shaken. And for a company built on managing other people's money, that's a dangerous position to be in. But wait, this isn't just about BlackRock. This is about a much larger system that's starting to fracture. What we're seeing with BlackRock isn't just a company problem, it's a systemic warning sign. When a financial titan like BlackRock starts facing pressure, it signals deeper issues across the entire credit ecosystem. Hundreds of corporations are now unable to service their debt. Defaults are climbing month after month. And financial institutions, which hold trillions in these shaky assets, are starting to feel the weight. Now, think about this. We're heading into 2026, a year already projected to be economically volatile, with uncertain Fed policies, global elections, and shifting investor sentiment. If this credit strain continues, it could lead to mass liquidity issues, sudden market sell-offs, and a loss of trust in some of the biggest players on Wall Street. And when trust breaks in finance, everything breaks with it. Now, here's what's really dangerous. Most retail investors, maybe even you, are completely unaware of what's building behind the scenes. Why? Because headlines talk about temporary volatility or market corrections. They don't show you the compounding debt, the silent wave of defaults, or the exposure that firms like BlackRock have quietly accumulated. Even if you're someone who follows financial news, it's likely you haven't been shown the full picture. And that's not your fault. It's just not in the interest of big firms to sound the alarm too early. They want stability. They want confidence until it's too late. But this video is different. You're not just going to walk away with fear, you're going to walk away with clarity. Because now we start moving toward the part you clicked for. Let's talk about the core issue, the part you came here for. BlackRock's exposure isn't just to high-quality corporate bonds. They've also been heavily invested in junk-grade credit, leveraged loan markets, and riskier mortgage-backed securities, all of which are now facing intense pressure. Here's the kicker. To maintain returns for clients, BlackRock has taken increasingly aggressive positions over the past few years, especially during low interest periods. But when rates spiked and defaults rose, those bets turned toxic. And now, they're sitting on billions in vulnerable assets, many of which could lose significant value if corporate bankruptcies keep rising. So when we talk about a potential collapse, we're not saying BlackRock disappears overnight. We're saying their role as a stable pillar in the investment world is no longer guaranteed, and that shakes the foundation for everyone else too. You might be thinking, okay, but I'm not investing in BlackRock directly, so why should I care? Here's why. BlackRock manages a huge portion of retirement accounts, ETFs, index funds, and pension money. If their portfolios take a hit, millions of everyday investors, maybe even you, could feel the shock. And if you're planning to start investing in 2026 or thinking of increasing your exposure, this situation should be a massive wake-up call, because it's not just about one company. It's about the structure of the market you're walking into. A market where credit is tight, defaults are rising, and major asset managers are sitting on unstable ground. If you're not prepared for that, your investments could bleed before they even grow. So, what can you do to shield your investments from this looming risk? First, don't panic. Reacting emotionally is the fastest way to lose money. Instead, focus on these key moves. Diversify your portfolio beyond corporate credit-heavy funds. Keep an eye on your asset manager's exposure to risky debt. Consider safer alternatives like government bonds or cash equivalents during uncertain times. Stay informed about the financial health of the firms you trust with your money. And most importantly, don't rush into investing in 2026 without fully understanding the risks. Because this isn't just a market correction, it's a potential credit crisis in the making. Knowing this early can save you thousands down the line. Now here's the final thought I want to leave you with. If you think you've got a handle on the financial landscape heading into 2026, think again. The BlackRock situation is a wake-up call for all investors, whether you're just starting or managing millions. Here's a question for you, and I want to see your answers in the comments. What's one financial risk almost no one talks about but could shake the market to its core in 2026? If you think you know the answer, drop it below. And if you want me to dive deeper into this topic, breaking down exactly how to navigate 2026's financial minefield, hit that comment section and tell me. If I get 100 comments asking for this, I'll make sure to create a detailed video just for you. What you've learned in this video is just the tip of the iceberg, only half the story. If you want to unlock the full picture and get all the insights you need to navigate 2026 safely, click the video on your screen right now to dive deeper. Don't miss out, your financial future depends on it. Until then, stay smart, stay cautious, and keep your eyes open.